Alright, I'm gonna continue the video here. So the purpose of this video is to go over a very, very basic system and some data points and how we can apply them. So this was the basic trend signal. Yeah, this is the trend signal system we were looking at. So I had some very, very basic rules. The entry rules were simple. Once the buy or sell signal is confirmed, enter the trade on the open of the next candle. Exit rules. Once a buy or sell signal is confirmed, exit the trade on the open of the next candle. So if it was a buy, you would exit on the sell. If it was a sell, you'd exit on the buy. And then the stop rules was to place a stop of 2 ATR from your entry point. Use the ATR from the candle that has confirmed the signal. So you wherever the signal was confirmed, whatever the ATR was at that point, you use a 2 ATR stop from the signal. So we'll just do a quick example. So we'll just go to ETH real quick. So let's just pretend signal is here. Tells me to buy. So I come down and I look at where the ATR was at the time of that buy. It was about $23. And we buy on the open of the next candle. So we would buy right here, and then we would measure out $23. And our system is using a 2 ATR stop. So our stop would be $46. That's 2 times the ATR. So we go down $46. And we can just place a line. This would be our stop. And this would be our entry. So we have our entry and our stop. So ATR is always changing, but we use 2 times the ATR. That's our stop. Theoretically, no matter what currency we're using, no matter what market we're trading, we can use this system because every market has ATR, and we're going to use that 2 ATR stop. And this is the benefit of using ATR as your measurement. So these are the basic rules. These are very, very simple rules to follow with that system. They pretty much don't require much thinking at all, because the system basically does the entries for you and the exits for you. This is not a video explaining how to build a system or what system you should be using. This is a video of analyzing a data set. So let's go over a few things. Let's go over a few things real quick. So right now we're gonna review data and SQN scores. Now this is where things really start to pick up. So here, I'm just gonna go over the data that I gathered. I use these rules on Bitcoin, and I went through the first 10 trades on the daily chart. I was gonna do all of them, but I decided not to because I'm not gonna be using this system anyways. So this is just for data purposes, basically. But just an example. So I collected the date of entry, the date of exit, what was the ATR at the signal, and then here, what was the negative ATR that we faced. So let me show you. So let's use this example. So we entered here at the open of this red candle, and let's say we exited up here on this green candle. Let's just say we would measure from our entry down to the bottom of however much it ran against me. So it ran against me $17. When the ATR was $23. So we would do $17 divided by 23. So this trade ran against us 0.73 ATR. Again, we're measuring everything in ATR, and you'll see how this can be useful. So on every trade, these were the amount that it ran against me. So the only trade that I lost, so every trade that, because I'm using a 2 ATR stop, so it would have, this number has to be over 2 for it to be a losing trade. So you see, that one was 1, that one was 1.5, so those were winners. This one was 2.5, so we lost. And then the other loser was not because it hit my stop, but it was because it signaled me to get out at a loss. So theoretically, if let's say we were using a 3 ATR stop, this would have turned into a winning trade. Or if you weren't using a stop at all, this would have been a winning trade. So the average it ran against me was 1.09 ATR. So if we had enough data, let's say we did this 100 times, this number would be valuable, because maybe I'm using a 2 ATR stop, but the average it ran against me was only 1. So you could probably get away with a 1.5 ATR, or a 1.2 ATR. You can get away with a lower stop. So the goal of a stop is to make it as close as possible without getting stopped out. That's how you make maximum profits. So I could have used a larger stop, and I will win more trades. My percentage of winning will be higher, but the amount that I'm gaining off of each trade will lower the higher I use. I like the idea of using a slightly bigger stop than is theoretically necessary, because different exchanges have different data. Like if you're trading on Coinbase or you're trading on Binance or whatever, like they can throw different wicks. They can have different data, even Forex. So you want to have a system that's comfortably safe, like comfortably making profits. I'd rather have a system that is giving up a little profits, but protecting you from certain events like that, than to try to squeeze it so close. So you can use this number to adjust what you're going to do in the future. Maybe your stop is way too far away, or maybe it's way too close, and you want to adjust that. And then I have just my average results based in R multiples. So let's go over to the data set. We had total trades 10, total wins 8, total losses 2. My average R profit was 2.791. So for every dollar I risked, I'm averaging a $2.7 return, which is pretty insane. My biggest win was 11.5 R. Your biggest loss should always be 1 R. Should always be 1 R. Now this may change when you're trading live, because there are fees associated with certain things. If you're including fees, or sometimes it doesn't get out at your stop perfectly. So this is theory. This is in backtesting and live trading. You always have to account for some, you always want to be safe when you're live trading, because there's variables, like I talked about, how the exchanges are different. There's fees. It doesn't always get out at your stop perfectly like it does when you're backtesting. There's other factors involved, so you need to take those into account. Longest winning streak was 5. Longest losing streak was 1. These are good numbers to know. The average exposure, the average time that it took from my entry to exit on my winning trades were 25 days. So that's a good, very good number to know. On average, it's going to take me 25 days. So you don't freak out after 2 weeks or 3 weeks. Oh my God, it's not moving or whatever. My average time on a losing trade was 2 days. Now these are where the numbers. These are the important numbers. There's 4 very important numbers out of all these. Your average R profit, that's number 1. Your standard deviation is number 2. Oops. Sorry. Your standard deviation is number 2, and your SQN, that's the ultimate number for me, which kind of changed the way I look at things. My SQN was 7.4. Then also your win percentage is also an important thing. We had 80% win percentage. Now, for this data to mean anything, you need to have a sample of at least 100 trades. And this is why I enjoy the ATR way of doing things, because it allows me to take this same system and I could apply it to all the Forex pairs. I could apply it to commodities, I could apply it to stocks, I could apply it to crypto. So it allows me to build up a data set, because if I'm just testing one chart, let's say I'm doing a weekly system or a daily system, if I'm just looking at one chart, maybe there's only 50 trades on the entire history of the chart. And I want to get my data set above 100. So once I get my data set above 100, these numbers become very, very valuable to me. Okay, so I'm going to go through a few they're not charts, but a few pictures that are going to really put things in perspective in terms of using this data to your advantage. So, okay, so we're going to look at recovery first. So I really like this. I think it really helps put things in perspective. So if we were to lose, let's say we start at $100,000. If we lose 5% of our account, we lose $5,000. We have $95,000 left. So when we have $95,000, to get back to even, to get back to that 100,000, I don't need to make up 5% of my account. I need to make up 5.3% of my account. So you can see, as you lose more and more percentage of your account, the amount it takes to get back to even goes higher and higher. And when you get to like this 30, 40, 50% range, things start getting really out of proportion. You now have to gain 100% to get back to even. You now have to gain 150%. You have to gain 300%. You have to gain 900%. So what this shows is the value of protecting your initial starting capital. That's number one, because for me personally, I would never, even if I'm trading a small account. I mean, if I was trading a really small account, maybe I'm willing to risk it all or something, but I would never want the psychological torment of losing 20 or more percent, because now it's like the numbers it takes to get back to even seems really daunting to me. It just seems too daunting to me. Like, I think I'm comfortable losing up to like 10, and it's not that big. It's not that big of a change at that point. So this is just a good representation of why you just never want to get down like past 25, because these numbers start building upon themselves in multiples, and it gets very difficult. So, and that's why, like, if you do lose 90% of your account, like, you're basically just done. Like, you're basically psychologically just completely out of the game, and you just don't want to put yourself in that scenario. So that's the first chart. The next chart is chance of ruin. Now, these are literally the most valuable graphs that I've ever come across. And if you're reading the Trading in the Matrix book, he will talk about SQN score a lot, but he doesn't really explain what it is or how it works or how you figure it out or any of that. And that's what I had to kind of sift through a bunch of stuff to try to get to the meat of what he was talking about. So if we go back to our data set, where is it? We go back to our data set, we had an SQN score of 7.4. Now just keep in mind, your SQN score means nothing unless you have at least 100 trades. It's just not 10 trades is not enough. 20 trades is not enough. But a little bit of data is a lot better than no data at all. So I really encourage to at least backtest 20, 30, 40 trades at bare minimum. And 100 trades is okay, and then 3 or 4 or 500 trades is probably like what you really want to be shooting for. Okay. So if we look at this chart, this has their different SQN scores. 7 is the high. 7 is basically a holy grail system. I don't really believe that there are 7 SQN systems out there. I don't really think it's a thing. If you have a 3, 4, or 5 system, you have a very, very good system. So if you create a system and you got an SQN score of 3, be very happy with that. That's something you should be happy with. 1 and 2 are probably not systems you want to trade. Like if you backtest a system and you get a 2 or a 1, you're gonna want to continue working on your rules to get that higher. 6s and 7s don't really exist. 5 is probably like the absolute max that you're ever gonna get, like reasonably. So here we go. This is our drawdown level. So if we have an SQN score of 3, let's say we have an SQN score of 3, and we do not want to hit this. We do not want to lose 5% of our account. So if our top priority is not losing 5% of our account, and we have an SQN score of 3, we are gonna use a 0.4% risk percentage per trade. We are only gonna risk 0.4% of our account per trade. Now with this chart, using this chart, it's if we had an SQN score of 3, and we're using 0.4% chance per trade, we have less than 1% chance of losing 5%. Okay, we have a less than 1% chance of losing 5% of your account. So you can really see how valuable this is. These are the charts you use to manage your account, to decide what is the optimal risk percentage for me. And first, you have to figure out what are your goals. Is your goal to maintain your capital, or is your goal to grow as fast as possible? So using the data that you collect, using these charts and some other methods that I'll go into and that I can elaborate on in other videos, you can develop a position sizing plan to reach whatever goals you have. So your position sizing plan is the number one tool that you can use to achieve whatever profit goals you're looking to get. So you have to first build your system, you get the data, and then you apply that data, plug it in, and figure out what you're gonna risk per trade and what your strategy is to achieve whatever profit goals you're looking to achieve. Because if I had $1 million account, you better believe I'm gonna be using this chart. I'm gonna be using less than 1% chance, and I'm gonna want to have a drawdown level of 5%. I don't want to lose 50 grand. I don't want to lose 50 grand. So if I have $1,000 or a few $1,000s, maybe I am willing to push it up to higher levels. Now there's another chart. This is the same exact chart, except instead of a less than 1% chance, you have a less than 10% chance. So using this chart, it allows you to increase your position size. If you're comfortable with a 10% chance of getting these drawdown levels, you can use this chart. Okay. One other chart. This is your system win percentage. On this system, we had 80% win percentage. All of these charts, this one and this one, the chance of ruin we just looked at, and this losing streak chart, these are based on a 100 trade sample size, done tens of thousands of times. They plugged it in over tens of thousands of times to get these numbers, so they're pretty accurate. So if you have a win percentage of 80%, over a 100 trade sample size, you're guaranteed going to lose 2 trades in a row. You're guaranteed going to lose 2 trades in a row. On average, you will lose 3 trades in a row. You have a 10% probability of losing 4 in a row. You have a 1% probability of losing 5 to 6. And the maximum that they ever lost over tens of thousands of trades was 7. So this chart's very useful because let's say you have a win percentage of 65. That's really good. That's really good. That's a really good win percentage. And your returns well, and you have maybe your SQN is like 4, or maybe you have a 4. You could have a 4 or 5 SQN score with this win percentage potentially. And then let's say you lose 4 trades in a row. That's gonna seem pretty devastating to you, losing 4 trades in a row. But in reality, that's average. Like if you trade 100 trades, which is very doable in a year's time if you're trading a lot, or maybe 2 years time, and you have to realize like, hey, that's average, like that's normal. And you have a 10% probability of losing 6 or 7. So you could potentially lose 6 or 7. So with this chart, it helps you realize like to not freak out when you do go on losing streaks, because they're actually normal. You know. And you could also flip this chart around for like your average chances of winning. So like if we had a 60% win rate, if we go down to this 40% number, you're 100% going to win 7 trades in a row over 100 trades, and your average is going to be 8 trades. So like your win streaks are going to should be bigger than your losing streaks. So this is just to keep you in the game psychologically when you're going on big losing streaks, and to see like, if you lost like, you know, if you lost more than 6 or 7 in a row, you may need to start looking at what you're doing, and maybe something is going wrong. But if you just lose 4 in a row, like that's really no reason, 3 or 4 in a row, that's really no reason to panic, because that's completely normal. And so maybe if you lose 4 in a row, you just you look at your previous trades, double check, and make sure you're following your rules, and then you just continue on with your day. Another thing backtesting will show you too is when you backtest 300, 400, 500 trades, these are going to become normal to you. You're going to be like, oh, I just lost 4. I backtested 20 trades today. Oh, I lost 4. Oh, I lost 3. Like, these losing streaks will become very apparent to you. However, when you're live trading, things are a lot slower. So when you go on a 4 trade losing streak, it might seem like a really, really just horrible losing streak. But it's in reality, it's just, if you go back on your backtesting results and look through your 200 trades, you're like, oh, I lost 4 trades a bunch of different times, but look at my results. My results in the end were still really good. Okay. So I'm going to go over one last thing. So with these charts, you might be thinking, well, this is just to prevent you from losing. But what if you have high goals? So what if you have a goal of, I don't want to lose more than 10% of my account, or I don't want to lose more than 15% of my account, or I don't want to lose more than 20% of my account. But maybe you have big profit goals. What if you want to make 100%? What if you want to make 100% at the end of the year? Or what if you want to make 80% or 50%, whatever it is? You can implement a strategy called markets money strategy, which will protect your starting equity, but risk more of your profits. So let's pretend we had a SQN score of 3, and we don't want to lose more than 15%. So we can risk 1.2% a trade. So let's say we start with 100,000. And let's say our first trade, we're gonna risk 1.2% because we're comfortable losing 15%. We're gonna risk 1,200, and let's say we make 3R times 3. So now we have 3,600 in profits. So now our total account is 103,000, 3,600. So what this does is if we're at $100,000 or less, we will never risk more than 1.2% because 15% is our maximum level that we can handle. But as we go up, 36. As we go up in our account value, we can now risk more. Now, why is that? Because if we do go down back to 100,000, we have to go back to this original percentage. So what we are doing here is we're protecting our core value. Like we'll call this core value. Oh, crap. Core value. This is our core account, which we cannot stomach losing $15,000 or more on this. So in order to protect our core value, we will never risk more than 1.2% of our core value. But we can risk more profits. So now that we have 3,600 in profits, we'll move this. We're gonna say we can risk 5% of our profits. So we take 5% of our profits. Should be 3,600 times 0.05. So $180. We're going to take 5% of our profits, and we're going to add that on to our core value. Okay, so our core value risk is 1,200. So now we just added 180. So now we can risk 13. Now we can risk 1380. Now we can risk 1380 per trade. Now we can risk 1380 per trade. Okay. Now you could, depending on your strategy, you could risk 10% of profits, 15% of profits, 20% of profits. And then I would probably cap out, depending on your strategy. You want to have a percentage level that you just completely cap out on. Like never go over like 5% is just already like kind of absurd. So you want to have a certain percentage to cap out on, like maybe 3. Like 3 is already like really high. So you could figure out like what percentage to cap on. And then what you want to do is have a profit goal. So you already know your goal in terms of risk is to not lose 15% of your account, of your core value. That's your goal with managing your risk. And then for your profit, maybe you say, I want to make 50%. I want to make 50%. So when you get to 150,000, you have some options. You could take your profits out of your account and restart with your core value and do the same thing all over again, which is probably what I recommend. Or if you want to let your account ride, keep the money in the account, but keep your money in the account, but go back, make this your core value now. So now instead of 100,000 core value, 150,000 is your core value. So in order to protect your core value again, you go back to your initial risk percentage of 1.2%. Okay. So this is kind of like a short overview of how you can use data to really hone your skills on what you need to risk. in order to achieve certain goals. So without this data, there is no, you can't really decide what you want to risk, because you can't. 2% I like, and I think it's good for beginners, and I think that's a good like rule of thumb. But when you actually look at the, you know, proper risk percentages, 2% is actually kind of on the high. It's kind of on the high end. And considering a lot of traders don't even have a system, they've never backtested anything, they're just randomly throwing their money at the market, like 2% is actually astronomical when you think about it. So these charts can really help you achieve your goals in a safe way and feel confident about it. So my conclusion is, like, in an ideal world, we would have a group of traders that are all dedicated to building and backtesting their own systems that we can all share with each other. This could improve all of our trading a lot faster, because it takes a lot of time to gather good data. It takes a lot of time to backtest. It takes a lot of time to figure this stuff out. So having other people who are committed to backtesting and stuff can really help with figuring out new ideas and where to go from there, how to improve. So that's going to be the end of this video. Thanks for listening. I hope you got something out of it. Thanks.